On the domestic front, while the fourth quarter 2016 GDP figure was better than the last two consecutive quarters, the economy remained in recession with inflationary pressures continuing unabated. These adverse external and domestic conditions continued to complicate the policy environment. In attendance at the meeting were 10 members of the committee. The committee assessed the global and domestic economic and financial environments during the first quarter of 2017, as well as the outlook for the medium term. The global economy witnessed greater momentum during the fourth quarter of 2016, facilitated by gains in both developed, emerging markets and developing economies, which propelled global GDP growth to 2.7% year-on-year during the fourth quarter, a 0.2 percentage points improvement over the third quarter of 2016. In spite of this development, the external environment continued to be plagued by political, economic and financial market uncertainties, with defining issues being the Brexit, the growing protectionist and anti-globalization sentiments, divergent monetary policies of the advanced economist central banks, and volatile commodity price movements. The protectionist stance of the new U.S. administration could impact negatively on global trade and economic recovery. The Monetary Policy Committee noted the slip in oil prices against the backdrop of fears of a supply glut, fueled by increased activities in the U.S. shale oil production, which threatens to undermine the rebalancing effects of the last OPEC decision to cut output. Committee also noted the increase in the target range of the U.S. Fed funds rate at the last meeting of the FOMC and the potential spillover effects on global capital flows and interest rates, especially given the still tepid global economic activity and weak demand. Challenges in the emerging markets and developing economies persist as they struggle with strong headwinds from low commodity prices, rising inflation, currency volatility, receding real income, and capital reversals. Overall, the committee noted the dampening effects of economic stagnation and uncertainty on global trade and investments. In spite of these constraints, however, the IMF estimates that the global economy will witness a slight improvement in growth from 3.1% in 2016 to 3.4% in 2017. Global inflation continued its moderate but steady rise against the backdrop of improved oil prices and depreciated currencies in several emerging markets. With a further upward adjustment in March 2017. Released by the National Bureau of Statistics in February 2017 showed that the economy contracted marginally by 1.3% during the fourth quarter of 2016, effectively remaining in recession since the second quarter of 2016. Overall, in 2016, the economy contracted by 1.51%, with the contraction during the fourth quarter being the least since second quarter of 2016. The non-oil sector grew by 0.33% during the fourth quarter, largely reflecting the slowdown 4.54% recorded during the third quarter of 2016. The committee remains of the conviction that fiscal policy remains the most potent panacea to most of the key negative undercurrents heightened unemployment, and high inflation. In spite of the recent moderate recovery in oil prices, the committee approached developments in commodity prices cautiously. It noted that the era of high oil prices was over, thus making diversification away from oil more imperative today than ever before. The committee noted that money supply contracted by 5.73% in February 2017, annualized at a 34.38% in contrast to the provisional growth benchmark of 10.29% in 2017. Similarly, net domestic credit contracted by 1.41% in February 2017, annualized to 8.46%, being significantly below the 17.93% provisional growth benchmark for 2017. Likewise, net credit to government contracted at an annualized rate of 49.74%, representing 82.86% below its program target of 33.12%. In effect, all the major monetary aggregates contracted by the end of February and underperformed their program provisional benchmarks for fiscal year 2017. Headline inflation year-on-year, however, declined for the first time in 15 months, dropping by 0.94 percentage points to 17.78% in February, from the 18.72% recorded in January 2017 and 18.55% in December 2016, similarly reversing the monthly upward momentum recorded since January 2016. The moderation in headline inflation in February 2017 reflected base effects as well as decline in the core component, which fell by 1.90 percentage points from 17.90% in January to 16.0% in February 2017. The food index, however, rose to 18.53% in February, a 0.71 percentage points increase over the 17.87% recorded in January 2017. Committee similarly observed a continuous upward trend in the month-on-month inflation rate in February, having slightly moderated between December 2016 and January 2017. It noted the sustenance of the structural factors mounting pressures on consumer prices,